My belief is that the increase in the gold price that we've seen so far, as an example, has more to do with central bank buying and the weaponization of the US dollar than anything else. I think retail buying falls on as a consequence of people feeling the real bite of inflation, and as a consequence of that, developing a fear for the ability that they might have with fiat savings instruments to keep up with the deterioration in purchasing price of their savings, which has traditionally been the condition precedent for an increase in the gold price and ultimately the increased prices of gold equities. In terms of the broader commodities, Anthony, I think the real story is the ascent of humankind, if you will. There are over 8 billion of us on Earth, more every day. We've done a great job over the last 40 years, increasing the material well-being of the poorest of the poor, raising 1.5 billion people from dire poverty being merely poor. That isn't to suggest that there's a lot more to do. There is, and we're going to do it. As poor people get more money, the things that provide utility for them are things that are commodity intensive. When wealthy people or middle income people get more money, they generally buy services, which are not commodity intensive. But when poor people get more money, the stuff that increases their sense of well-being is often stuff that requires stuff. The great commodities boom that we saw as an example in the decade 2000 to 2010 really came about as a consequence of the urbanization of China, and that process is being repeated around the world. As a consequence of that, I am bullish about the whole industrial materials segment, with the sole caveat, no, that's not right, with two caveats. One caveat would be the increasing role of government and the increasing amount of government theft with regards to privately generated wealth, including in natural resources. And the other would be the threat of recession. I'm no economist, but I note that sort of once every decade and a half, something goes way wrong. And it's been a while since something went wrong. So I'm a little nervous about the specter of recession, which would delay rather than change my forecast of increased commodity consumption and reduced availability. Sorry for that long-winded answer, but you asked, so I answered.
According to Rick Rule, the increase in gold prices can be attributed to central bank buying and the devaluation of the US dollar, causing inflation concerns among retail investors. As economies worldwide, including China, continue to urbanize and grow, there's a growing demand for commodities, particularly industrial materials. However, Rule emphasizes caution due to the increasing government intervention in wealth distribution and the looming threat of recession. He also credits Deng Xiaoping's economic reforms for China's infrastructure development. With gradual liberalization of economies globally, there's a recognition that private enterprise fosters economic growth. In China alone, urbanization is projected to add another 150 million people in the next 2 decades.
Well, I would argue a little bit with your first premise. I think the increase in Chinese wealth that enabled them to build out the infrastructure really can be linked back to Deng Xiaoping saying to be rich is glorious, and the undoing of the communalization of farmland in China and the allowance of private enterprise. The Chinese made the money that allowed them to develop the infrastructure by building an export-oriented economy and selling stuff to us. The Chinese benefited from low-cost labor and all those things before Deng Xiaoping said to be rich is glorious. It was the privately led economy that allowed the state to build up the resources to build the infrastructure. I think it's very important not to put the cart in front of the horse. And we're seeing this gradual liberalization of economies around the world, sadly, with the exception of Western Europe and the United States, which have experienced and seem to be retrograde liberalizing economies. But I think from economies as small as Malawi to economies the size of India, what you're seeing is a gradual realization that allowing some form of private enterprise makes the commune, if you will, the community, substantially richer. By the way, the work isn't done in China yet either. The Chinese estimate that urbanization needs to reach another 150 million Chinese in the next 20 years.
Rick Rule discusses the future outlook for commodities, focusing on the opportunities in oil and gas. He challenges the notion of peak oil demand by 2030, suggesting it's more likely to occur around 2065. Rule highlights the profitability of oil and gas companies and the potential for supply shortfalls in copper due to underinvestment. While he remains bullish on industrial materials, he advises caution in niche markets.
I think all commodities will benefit, but I think that investors will benefit from the biggest markets the most, which is to say they require the least effort, and they have the biggest and the best companies in them. So I would start with the oil and gas business. There's a perception around the world that, fostered by the big thinkers, if you will, that peak oil demand occurs in 2030 or 2032. This is pure hokum. Peak oil demand probably occurs in 2065. If you think about peak oil demand occurring any quicker, how would the big thinkers manage to fuel all the private jets that they fly to Davos to tell you to drive less? The truth is that we have invested as a group well over $5 trillion now to increase the market shares of alternative energies in place of hydrocarbons. And we've reduced the market share of hydrocarbons from a high of 82% all the way down to 81%. So I would start with oil and gas, not that I think it's going to do better than other commodities, but simply because it's such a great business. At current oil prices, oil and gas companies are making a lot of money. Despite the fact that they're making a lot of money, in particular, the state-sponsored sector isn't spending enough money on sustaining capital investments to maintain production, which sort of suggests that prices will stay higher for longer. As I say, not maybe the commodity that will enjoy the greatest price increase, but the one that offers the greatest stability and the greatest free cash flow and the least risk for investors. I'm certainly a copper bull as well, but I'm not alone in that thesis. We have underinvested for 30 years in the exploration for and development of copper mines. The consequence of that, with the electrification of the world, is that we face almost certain shortfalls, supply over demand. The timing of that really is a function of whether or not we enter a recession or not. You can reduce supplies if you reduce demand via a recession, and you still don't get a price increase. Absent a recession, I think the copper business looks extraordinarily good. For investors willing to do some more work, I think that there is a lot of money to be made around the themes of rare earth and specialty materials, but these are not broad markets and these are not big companies. This is a very risky area that requires an awful lot of focused work in return potentially for some quantum returns. But the truth is I'm bullish on most of the industrial materials over time. Remember, Anthony, the cure for low prices is always low prices, and the cure for high prices is always high prices. The delta right now between 1 million BTU of natural gas in West Texas at sort of $1.80 to $2, and the price of that as LNG landed in Rotterdam or Shanghai or Tokyo at $8.50 per million BTU is too great a delta to last, and it's going to be resolved. I don't think it's going to be resolved absent some supply. But the truth is, as LNG becomes more available, not just in terms of price, but also in terms of reliability of supply, I think that you'll see the market for LNG really, really, really recover. Remember, again, Anthony, since you work for a major oil company, the BTU price disparity traditionally between both land-borne and liquefied natural gas and, of course, crude oil, its principal competitor. And you'll see that there's a lot of room left in the natural gas market. Will there be softness as a consequence of trains, 4 and 5 coming on in Qatar and the Northwest Shelf, and the continued ability of the United States to find export markets for their gas, and perhaps Prime Minister Trudeau willing, the entrant of Canadian liquefied natural gas on the market? Yes, absolutely. Is this a problem in the 10-year time frame, in the 20-year time frame? Absolutely not.
Today, we delved into an insightful conversation with Rick Rule, uncovering key insights into the world of commodities and investment opportunities. From the factors influencing gold prices to the future outlook for oil and gas, copper and LNG markets, Rule provided valuable perspectives for investors. As we wrap up, remember to hit the subscribe button, give this video a thumbs up, and share your thoughts in the comments below. Stay tuned for more valuable content, and thank you for watching.